Hey everyone, and welcome back. Today with me I have my nieces whose names will not be shared, but I'm excited to have them here today because we actually talk about investing on pretty much a daily basis, and I thought this would be the perfect opportunity for them to learn a little bit more about investing, and if they understand it, hopefully I'm making it clear for everybody to understand it. So last time we talked about how you can start investing in 3 easy steps. Number 1, open an investing account. Number 2, send money to it consistently. And number 3, actually invest it. So those were great steps for beginners to just get into the process of investing. However, this week, we're actually going to talk about how you can be a lazy investor.
Why do you want to be a lazy investor? Don't you want to be a good investor?
They scripted it so well. I'm so proud. No, in all honesty, they did ask this question while we were creating our content for today. And it's a common question that I get asked. Why do you want to be lazy? Let's do it well. I said lazy, not poorly. I am always the type of person to work smarter, not harder. So how can we do so? How can we put our money to use without struggling with putting it to use? Becoming a lazy investor is a great place to start for those that are new to investing, don't enjoy investing, simply don't have the time to, or those that don't yet have access to a financial advisor and are searching for one right now.
At least one of those are us.
Probably. Before I dive in, this is not investment advice, and it should not be your comprehensive goals around investing. There's a lot that goes into investing, but it's a great place to start. And keep listening as you continue learning. So here are 5 tips for today. Number 1, send money to your account consistently. This should sound familiar because it was a tip we talked about last time, but here's why it can also be considered a lazy tip. If you set up those automatic account transfers from your checking account to your investment account, you're not forgetting to set that money aside on a monthly basis. So by doing that, this allows you to then take advantage of lazy tip number 2. And lazy tip number 2 is to leverage dollar cost averaging. Dollar cost averaging is the idea that you consistently invest money into the stock market. Whether it's monthly, weekly, daily, you get the idea. And sometimes your investment amount allows you to purchase a little bit more, and other times maybe not so much, depending on that cost. Overall, though, you take the average of what you've invested it in, and it balances out in the long run. So the analogy that the girls and I talked about was buying a book. And right now I'm reading The Business Playbook by Chris Ronzio. And we talked about how today, if I wanted to go into the bookstore and buy this book, maybe it cost me $5. And next month, maybe I go in and it costs $7. And then 2 months from now, maybe $3. But if I've purchased the book every single time, overall, on average, it costs me $5. That's the idea of dollar cost averaging when it comes to the stock market. Sometimes the stock that you purchase is going to cost you a little bit more. Sometimes it's going to cost you a little bit less, and that's just due to the natural fluctuations in the stock market. As a lot of people know, investing is emotional. So if there is emotions that are driving where the market is going, sometimes emotions are at a high and sometimes emotions are at a low. We just get to invest on an average basis. Don't try to time the market and consistently put money into it. Tip number 3 is to invest in the market rather than individual investments. What do I mean by that? Well, if you take anything away from today, this is the tip I want you to pay a special attention to. Wouldn't it be nice if I told you you could own up to 500 pieces of some of the best companies in the market with just one single purchase?
Absolutely.
Mind blown, right? Not realistic, maybe? It is.
Definitely not.
It is though. So that's actually what an exchange traded fund or ETF does. Rather than purchasing individual stocks like Apple, Google, Tesla, or Starbucks, you can actually buy all of them and much more, in fact 496 more, by buying the S&P 500 ETF SPY. The S&P 500 index actually consists of 500 companies, some of the best ones in the stock market, big names that you guys know, like Amazon too.
Yeah.
All right. So by purchasing the SPY ETF, you actually hold a portfolio of stocks in companies that are included in that S&P 500. It's called 500 because it's 500 companies. So just a little disclaimer, if you'd like to see what types of companies are included, you can check out the link in the video description or in the podcast show notes. But here's the benefit of it. Not only does this take the guesswork out of what to buy, but it also allows your money to go further. We're recording this video January 17th, 2022. And as of today, the SPY ETF is currently trading around $465 a share. Now, depending on where you stand with your finances, that might sound like a lot of money, or it might not sound like a lot at all. But let's give an example. The 4 stocks that we mentioned earlier, Apple, Google, Tesla, and Starbucks. As of today, they're currently trading around Apple, $175 a share, Google, $2,790 a share, Tesla, which is $1,050 a share, and Starbucks, $100 a share. Now, some of those are less than $465 and others are much more than $465. So here's the idea. You can either buy each of these stocks individually, or you can buy the ETF SPY, which holds a portion, a piece or sliver of all 500 companies included in the S&P 500. So you see, not only does it take the guesswork out of what to buy, it allows your money to go further because you can buy more stocks with the same amount of money. But really, the last main benefit of purchasing the entire market, the entire S&P 500 ETF, rather than the individual stocks, is that your investment portfolio is more diversified, right? You're not putting all of your eggs in the Google basket or all of your eggs in Tesla or Apple or Starbucks. You have all of these 500 different eggs in one basket. Tip number 4, reinvest your dividends. Some of the companies you'll own will actually provide you a dividend payment on a consistent basis. And that basis is entirely up to that company itself, whether they issue a dividend or not. In your investment account, though, there's typically a button that you can check off that states reinvest dividends. And what that means is that whenever you get paid a dividend, it will get reinvested back into that same investment that you had purchased, rather than your cash sweep account, rather than that holding cell of where your cash goes before you actually buy that money. So in other words, when you get these little pieces of income back from these companies, you can get little bits of more shares of these different pieces rather than letting it sit there and accumulate, which is also a benefit. However, if you're trying to be a lazy investor, why not just have it reinvest automatically? Why not just be invested right from the get-go? So then the last lazy tip for today is to be patient. And that takes a lot of work just to be patient, which sounds ironic, but avoid reacting to the market changes if you can help it. I encourage you to invest for the long term. It's a great way to be lazy, and have patience. This will take some time, but it's worth it.
A couple months ago, I invested $20, and it literally has grown 8 cents.
8 cents, that's not bad, kid. Not bad. Do you remember what you purchased?
No.
That's okay. That's okay. Bottom line, guys, we went over a lot today. So if you have any questions, please don't hesitate to reach out. Keep an eye out for more content as we continue to unpack investing and other New Year's financial resolutions.